Markets are closed on Monday, and with a shortened holiday week, we will do a shortened weekend video. A pullback certainly started on the Friday session, but is it anything that we have to be concerned about? That's the main question we'll look to answer in today's episode of the Weekly Watchlist. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe if you've not already done so. And stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. SPY weekly timeframe chart kicks us off. What do we see here from a structural and location perspective? Certainly a solid green-bodied bar, but it would be irresponsible to not at least acknowledge the upper wick that printed here. It's not enough to turn it into an inverted hammer, and we did close in the upper third of the weekly range, so I would still say that structure does belong to the buyers at this point. On the location stand front, we do have a bar-to-bar higher low, as well as a very substantial higher high, so 2 for 2 bulls in control on the weekly, but it goes further than that. We of course know that we're breaking out of a weekly ascending triangle pattern that looks something like this. That of course is a bullish implication as well. And if we come in with the Fibonacci's, this is a new development here coming from the all-time high to the low from October. This past week broke out firmly over the 61.8 Fibonacci, and as we know, the more time we can spend above a 61.8, the odds of a 100% retracement dramatically increase. I'm not calling for new all-time highs tomorrow, the next day, next week, next month, but over time, once again, the more time we can spend above the 61.8, the higher those odds are that we go back up for the 100% retracement. With that said, we can zoom in and of course understand that the weekly trend is certainly up with lows, higher lows, higher lows, higher lows, highs, higher highs, higher highs, higher highs as of this week's close. So we're certainly in a weekly uptrend, and we can certainly afford a pullback to get all the way back down to the breakout point here for a break retest. If we find a higher low, the weekly trend will not be jeopardized at that level. But it goes further than that. You can also take the fibs from the low of this most recent leg higher, and you'll notice that your 38.2 ideal bull flag consolidation zone is right on par with that flat top breakout point from the ascending triangle. Let's check in on the volume profile from the weekly perspective. We know that we've broken out once again over that magic area. It's right around SPY 420, the breakout of the ascending triangle. So that also provides confluence of support on the downside if we get a pullback. Not advocating that we will. Obviously, the structure and location is bullish here, but if we do, that's kind of your line in the sand for a number of reasons now. And this week, we did run into the overhead high volume node. So that upper wick that we were just acknowledging from a structural perspective, if it does lead to some more substantial pullback, it would make sense, right? This is a logical area for the market to back off from, but it's not going to change the weekly trend. If we think about the next overhead target, there's nothing really up here from a volume-based perspective. The structural element to start focusing on is much closer to SPY 460. Don't think we're going there though either in a shortened holiday week. Let's take a look at the daily and get more nuanced. Let's first evaluate the expected move. If you're not familiar with this study, check out the tutorial in the top right-hand corner. If we're contained by the upper bound here, the number is technically 444.75, and it is a very nuanced higher high, but for the sake of today's video, let's call it an equal high. If we're contained by the lower bound of the expected move, the number is 434.20, that of course is a big time higher low. So even though we don't have a higher high, I do think expected move here is bullish. If you wanted to lean slightly more neutral, that would be acceptable as well. For the most part, we know that we are still very much so in a daily uptrend, tracking higher lows and higher highs along the way. The daily line in the sand for a higher low pullback wants to be above the breakout point from this bull flag. We talked about this on Thursday, 429.25. Clearly, that's far extended through the lower portion of the expected move for the week. So what looks a little bit more reasonable? Well, we talked about it on Thursday. It's really Wednesday's high, and that's exactly where we find ourselves on the Friday afternoon session. Now, there's no daily implication for a reversal yet, but let's think about this. Is this an indication of stronger sellers, or is this just a mild pullback, right? Well, Friday was the quad witching day. It was also a dividend payout for the SPY. And what did we get? Did we get a catastrophic failure? Did the markets break and everything go to zero? Absolutely not. It was a very mild inside day where we hardly even retraced more than 50% of the preceding day's range. So if anything, this is bullish structure still on the daily time frame chart, and there's very much so a possibility that early on in the week week, if we hold here at 438.75, we're off to the races, putting in more bull flag consolidation, and from there over time, we will look for a breakout. But to be a little bit more nuanced than that, let's take a look at the hourly time frame chart and build a game plan based on some very specific levels. So first and foremost, you can see that we did try to respect intraday right here, this final breakout point from the Thursday session, right? That's the afternoon breakout on Thursday, but it didn't really hold, right? We ran into it for support a number of times. You can see the first hourly bar of the day produces a lower wick off of it. We produce the green bar here, but we get a lower high and break underneath. So that really does set up the deeper pullback to continue into early this upcoming week if bears can keep prices underneath that level, 440.75, building out consolidation in here. We will look for a flush and breakdown of Wednesday's high for a retracement deeper towards the FOMC breakdown level. That's the lower edge of the expected move for the week, around 434.50, 434.20 is the lower bound of the expected move, right? So this is the target on that bearish setup if we get price acceptance early in the week under 440.75. Now, if the bears or sellers really fail to materialize under a break of 438.75 and we get a look below and fail, something that comes back into this range, I would be all eyes on a higher low above 440.75 right here to be targeting equal highs at the 444 level, because technically in the cash market, this poor high was not repaired from the Thursday session, right? On Thursday, we know that the futures left a poor high there. On Friday, the futures market gapped over that poor high. The cash market did not due to the dividend payout. So 444 does strike me as a very plausible target if this is the scenario that builds out. So there's your roadmap. Let's see if we get any confluence with our Fibonacci's. If you watched Thursday night's video, this should be really no surprise, right? From the low of the breakout of the daily bull flag to the top of the move from Thursday, your 38.2 is providing confluence of support around this area at 438.75. And we can also throw on an anchored VWAP from the breakout day last Friday here, and you'll notice it's going to slowly, it's not there yet, but it will slowly start to creep up and get there for confluence. Now, an interesting theory to at least acknowledge would be if we do get that fake break from the sellers, something that does this, fake break underneath that finds support at this VWAP, if it's not providing confluence at that time yet, and then it comes back above, oh, you better believe this is the situation I will be looking for into the future on that higher low up and over 440.75. With all of that out of the way, let's take a look at some supporting evidence. Market internals are always Exhibit A. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. Let's keep it very simple. Does Friday look like new money aggressive selling, or does it look like mild pullback? If we start with volume flows specific to Friday, we did not breach negative 300 million in the downward direction. So on the individual day, not bearish, not indicative of strong aggressive new money selling. The net flows on the week are positive at positive 437 million, not quite at our substantial read mark at 500, but certainly inflows as opposed to outflows. If we look at the advanced decline line, we start very close to trend higher zone. I will give credit where credit is due. There's a straight shot lower through the zero line, not a whole lot of opportunity there for responsive trade. But once again, are we sitting down below in trend lower zone? The answer to that question is simply no. If we look at the cumulative build on the tick, it is negative. So once again, there is some downward pressure there, but is it substantial? Is it significant? The answer to that question is no. We want to be north or south of positive or negative 4,000 for that to really stack up as a solid data point. It really looks like mild pullback activity to me, more so than anything else here. Market profile is always Exhibit B. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. There's a ton of nuance to talk about in today's profile examination. So let's keep it simple to start, and then we'll dive into some more complex analysis. The value area and point of control from the Friday session are centralized in Friday's range. They did not migrate lower with price into the close there. That does strike me as a more neutral and just simply not very bearish data point. Sellers unable to commit a lot of volume towards the lows of Friday's session. You'll also recall that I said that in the futures, we technically repaired the poor high from the Thursday session. You can see that here. But in its wake, we technically left behind a mechanical top, also aligning with the value area high. If we breach 44.85, there should be a quick scalp to test Friday's high up towards, what's the number here? Let me get that for you, 44.9350 in the ES futures. So that's a very quick upside scalp that may be available if we open and stay within Friday's range on the Tuesday session. Now, it gets interesting on the downside too. Bear with me here. Remember that this was our key zone to watch for a pullback. It was Wednesday's high and the value area low from Thursday's session. But beyond that, notice that we have a string of single prints here. And perfectly aligning with the start of single prints is a prior point of control. So if we do start to see a more aggressive breakdown here and the sellers can get prices in between this zone under 44.40, but above this point of control and confluence with value area low, or excuse me, single print start, that number is 44.28. If we can get here, the short side scalp is a breakdown into the single prints to close the singles, and lo and behold, this is a mechanical level as well. The low of Thursday goes right to the value area low of Wednesday, right? That target is much closer to 44.05. So how do we ultimately put all of this in action for next week's worth of trade? If we open inside of Friday's range, we'll keep an eye on 44.85, leading to a quick scalp to Friday's high. If we open in range and start to break down, getting underneath 44.40 is the first step to lead to a larger breakdown through the single prints underneath 44.28. That's where the larger downdraft may occur to the low of Thursday, 44.05. So a lot to think about here, but it very clearly illustrates the deficiency in structure underneath us that's worth paying attention to. I want to do something a bit more fun for our sectors on today's episode of the Weekly Watchlist. So we're looking at 3-year daily time frame charts. You can see that your XLK tech sector, the heaviest weight risk on sector of them all, is basically sitting on brand new all-time highs, right? So did this present leadership? Did it really fuel the leg higher out of the SPY? Absolutely. This is exactly what we wanted to see. But 2 questions to really consider at this point in time. Is it reasonable, number 1, that we could pull back off of an all-time high retest after a 100% retracement with very minimal pullbacks along the way? The answer to that question to me would have to be yes, it is reasonable. Number 2, is the daily or even weekly trend in jeopardy of reversing to a downtrend even if we get that pullback? The answer to that question strikes me as being no. We are clearly in an uptrend. There's clearly an opportunity for a higher low to be produced. This chart does strike me as being bullish. We'll just stay on these high levels and filter through them. XLB materials, lightweight sector. Any concerns about leadership here? Absolutely not. Not a concern. XLI industrials, right? This is breaking out of a consolidation range from here. We know that there's a $6 expected move over 103. The target there would be 109, and that's producing a brand new all-time high. This is technically roughly, somewhere around 8% plus of the S&P. That's a bullish look here out of industrials. Really liking this. It can certainly afford higher lows over 103 for a break and retest, right? The chart does look more bullish than bearish. XLY, this is a great illustration just to show that even if the XLK pulls back and starts to slow down, something like the XLY can pick up the slack and make this rotation closer to the all-time highs and keep the rotation going, basically. Now, I'm not making the call that the XLY is going to have an easy, smooth sailing journey to all-time highs. I'm not implying that we're going there this week, next month, the month after that. I'm just pointing out that there is still legs for this rally to continue based on the location of this chart currently. If we zoom in, there is a little bit of a nuance here that is worth at least talking about. We know that the XLK can pull back based on its location. Technically in the XLY, it is a heavier weight risk on sector, so I want to point this out. We do have a look above and fail on the Friday session. You want to see higher lows being produced over 163, and that could be a target on a pullback based on the look above and fail pattern, right? Let's move along and take a look at the XLC. Communications clearly producing like a monthly inverted head and shoulders. If you take a measured move from this and stack it on top, we're just going to eyeball it, right? That's bringing you much closer to, 75. Plenty of room for this to run in the upward direction. Once again, not a call that we go there this week, the next week, or even next month, just pointing out that there is continuous room for this market to rally in the upward direction. XLP consumer staples, is there any leadership out of this D for defensive sector? Absolutely not. It's done nothing. Hasn't really as significantly rebounded off the lows. Don't get me wrong, it is higher here, but it's not exhibiting leadership, so no issues with that. Same thing with real estate, really lightweight sector, still stuck sideways at the lows. XLV, healthcare, second heaviest weighted sector by market cap, but as we know, it technically is D for defensive. Is it exhibiting leadership, breaking out of this range, making new all-time highs? The answer is no. In the grand scheme of things, is it falling off of a cliff, breaking the range in the downward direction? The answer is also no. So from this very zoomed out 90,000 foot view, everything's really all good in the sectors. Day to day, obviously there's some inflection points to deal with, but I figured that this would just be an interesting change of pace for us. XLU, once again, D for defensive lightweight sector. Any leadership here? Absolutely not. Nowhere near the highs. It's not also breaking down aggressively from a range. All good. XLF, this is where we need more leadership to start to step in. We've talked about this in the past couple of episodes. It would be more ideal if financials could get up and over from this 90,000 foot view, this prior swing high from here before the banking crisis really sent this thing back down towards the equal lows. Because this is an important sector as the market rally tries to continue based on rotation, let's talk about what happened on Friday. Once again, your look above and fail, very similar to what we just discussed in the XLY, is worth noting here. We gap up and over the daily 200 SMA, up and over the Thursday high. Couldn't really find a turnaround to stay above that and consolidate out above. So I would think that maybe there's an opportunity for a pullback to 33.20. That would be your rainbows and butterflies situation. If the XLF can turn off of that and then get back above, good to go. The rotation is very well and alive. We'll look for bullish outcomes. If it starts to fall under 33.20, a little bit more of a red flag out of financials. Last but certainly not least is energy. Maybe it is actually least. It's just consolidating into a wedge on this high time frame. Something like a monthly would look like a bull pennant, but it's slowing down. Another thing to remember here, right? XLE energy, it's inflationary. This is what inflation looks like. This is what, stabilization looks like. So in the grand scheme of things, not really seeing any big concerns out of our sectors. Here's the sector ratio grid. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. Once again, we're leaving this zoomed out for a 90,000 foot view. Technically, it's just a year's worth of price action or ratio to consider. XLK, tech sector, heaviest weight risk on, does absolutely look risk on. D for defensive out of the XLV, but it is the second heaviest weighted sector. We just saw that the structural chart is really not a major concern. No big deal there. If we look at the XLF, obviously this is your banking crisis panic, and this continues to be a red flag. Nothing new here. Same old song and dance. Aerosmith, let me know down below in the comments section. XLY, consumer discretionary, trying to build out a healthy new uptrend, producing a higher high into the end of last week. This does strike me as constructive and bullish for that chart. Closest tie to the XLK is the XLC. Strong uptrend here, risk on indication. What do the risk off sectors look like? Are any of these charts in uptrends? Are any of these charts looking bullish? The answer is simply no. Let's take a look at the XLY over the XLP for growth versus value. Brand new higher high. Wanted to point this out. It's very nuanced, but we did produce a higher high on the Thursday session, pulled back mildly into the end of the week. This is a total risk on look, very clear opportunity for a higher low and to still maintain an uptrend. So thank the market gods. Thinkorswim finally restored the dollar data down here. There's no special setting that you have to hit. I just logged in and magically everything was back to normal. Much easier on the eyes here. So what do we see from a price action perspective now that we can finally understand the candles? If we look at Thursday's activity, strong breakdown, clearly putting upward pressure on equities over here. Friday technically fake breaks the low, closes back inside of Thursday's range. It's not the best looking rally, but if we stay in Thursday's range, it would certainly support the thesis that further pullback can unfold in equities down below. And if we just double check with what's going on over in the gold contract, it would certainly confirm with a lack of a recapture here up and over the $2,000 mark. Let's take a look at the 10-year interest rate, what's going on in our TNX. It is stabilizing, I'll give it that. It's no longer really trending in the upward direction here. It's going sideways, but it is above the top of the prior balance range in here. To be more helpful for the tech sector to break through the all-time high, you probably want to see interest rates break back down underneath 3640, and you could start to think of it as a potential neckline of a double top if it wants to break that neckline in the first place. 3640 is the key level, but let's take a look at some implications from the tracker tool. So the Fed tracker tool is certainly showing higher for longer with one more rate hike in the next meeting for July, bringing the terminal rate up to 525 to 550 basis points. But you'll remember that in the new SEP that was released during the FOMC statement on Wednesday, the terminal projection is going to be 5.6 from the Fed, technically two more rate hikes to achieve that as a terminal rate. And the market is calling the bluff of Powell, but I would not expect the 10-year to dramatically drop if we're already calling the bluff by saying, nah, we actually only believe in one rate hike. I certainly wouldn't believe that the 10-year wants to break down aggressively under those circumstances. If you look at the 2-year yield as well, it would sort of agree with the rebound it has made higher over the past couple of days. The next thing that we really want to focus on from a fundamental data perspective is that J. Powell will be testifying on Wednesday at 10 a.m. and Thursday at 10 a.m. It's on monetary policy. I don't really think that we learn anything new that wasn't already said during the FOMC, but if we fast fast forward another week, what we will be getting and what will be significant is 2 Fridays from now, the core PCE index will be coming out. You better believe it's all eyes on services, specifically housing and shelter services. Risk appetite charts continue to show absolutely no flight to safety, speaking to a risk-on environment down below. If we take a look at the bonds in terms of ratio of short-term to long durations, this is clearly not making new higher highs, and this also is not making higher highs, actually flipping into a local downtrend here in the IEF versus TLT. That's more of your medium-term bonds, but nonetheless, in the past, we could very clearly identify when there was an FOMC reaction. You could hardly tell that there was an FOMC statement on Wednesday based on the activity from these reads in here. When the market is very well in tune with what Jay Powell is about to say, that's usually a market that's content, and it's usually a market that can continue in the upward direction without any surprises. Let's take a look at something like the HYG, what's going on over here. The main takeaway here is that ever since the market, the equities down below, broke out of the April balance range and has formed an uptrend here, the HYG has been playing nicely. There are no major negative divergences in the junk bonds as of right now. And something else that is fairly interesting is taking a look at Bitcoin. With all of the bad news surrounding what's going on with Coinbase and Binance, you would imagine that there's likely some fear and panic. But even as we sweep the prior bars low, on bad news, there's no retracement through the thin structure, and we've closed back inside of the prior weekly green bar. It's not to say that this immediately means markets are going to new all-time highs, but it does speak to the risk-on sentiment of financial markets at this point in time. Market breadth and new highs versus lows is getting better, not worse. If we take a look at the SPX A200R, it is getting better and not worse, recapturing that 50% mark. And the most important one that we've been tagging along with is the SPX A50R on a daily time frame chart. A very interesting nuance that is certainly worth pointing out here is that even as Friday produces a red day and pulls back, we actually get a higher high. Very nuanced, but it is there out of the SPX A50R. That, to me, speaks to a broadening market rally, not a contracting market rally in terms of breadth. Let's take a look at the RSP. Still some work to do here in the equal weight S&P 500. Note that we have broken out over this top here, but there's the potential to reject off of this nuanced data point here at 150. Keep your wits about you. If the RSP wants to pull back, ideally, it's just a higher low this time around above 145.75 to keep us in an uptrend, and we'll look for continued improvements on the retest of 150. If it falls underneath 145.75, much more of a red flag for our markets. Let's take a look at the Dow Transports versus Industrials, and what we can see over here is an equal high out of Industrials, whereas we do have technically a higher high in Transports. Keep an eye on the relationship until it really deteriorates. Unless this really cannot produce a higher high up and over the level, it's not a concern yet. But if it can't, if there's a sharp rejection here and this hangs out at the highs, that's much more of your red flag. VIX volatility just produced the lowest low that we have on the chart in front of us here. And I know I sound like a broken record, but I'll say it until I'm blue in the face. Just because volatility is low, sub 15, does not mean that the market must crash. I'm sort of hopeful in the back of my mind. Maybe we have new viewers who are tuning in and making it to this stage in the video. If that's you and you're yet to comment on a video, I'd love to hear from you down below. But here's just that classic example, right? The VIX is historically comfortable underneath 15. It's only the paradigm shift from the sickness over here that caused volatility to spike and build out a floor above 2050. Other than that, historically, we like to be sub 15. If we take a look behind the curtains, though, at something like the VVIX, this classically gives us a little bit more insight as to what potentially is brewing underneath the surface. Notice that we're continuing to reject the backtest of the trend line here, sort of in the sweet spot, going sideways in this range. It's not extended over 103, and it's also not down below in complacency zone around 75. So volatility is really not a concern for this market right now. Let's take a look at the VIX futures. I did go ahead and roll forward the spread between the two to the N versus Q contract, instead of the M versus N. We're still in a strong contango here. We are working our way underneath the zero line in 9 versus 30-day VIX in this box right here. And even the one-day VIX, as we pull back on Friday, it didn't budge. It didn't spike. It didn't get up here towards, these elevated reads that we've seen in the past. So volatility is really a nothing burger at this point in time. If we take a look at the skew, this has been a talking point from a past couple of videos here. It got up to elevated elevated reads. But once again, just because the skew is elevated does not mean that the quote unquote forecasted black swan, not guaranteed, but forecasted black swan needs to happen. This speaks to 30-day tail risk, and an elevated read is not nearly as important as a depressed read here when bears are capitulating, right? So nothing came of this, and it's another reason not to panic just because skew is elevated. Volatility, once again, is a nothing burger for this market. QQQ weekly time frame chart. What do we see here from a candle structure and location perspective? Very similar to the S&Ps with a solid green-bodied bar, a little bit of an upper wick there, but nonetheless buyers able to close in the upper third of the week's range. So from a structural perspective, buyers in control. If we think about location on the bar-to-bar count, higher low, as well as a substantial higher high. 2 for 2, buyers remain in the driver's seat here. An overall pattern that's been in play for quite some time now is this very sloppy, but it's technically there, inverted head and shoulders that's been breaking out for quite some time now. We've obviously just produced a mega higher high. If you think highs, higher highs, higher highs, super higher high, there it is. Don't step in front of Superman. Bullish chart. There's nothing really bearish that you could say about the QQQ chart at this point in time. If we take out the Fibonacci's from the all-time high to the October low, just like the S&Ps, a more substantial break over the 61.8 happened this week, and that then increases the odds that over time, not this week, not next week, not next month, but over time, the 100% retracement does become more likely. Just to draw a parallel, remember that the XLK basically just gapped up to new all-time highs on the Friday session, right? So it's really not that far-fetched based on this weekly time frame happening over time and resolving over time. The more time we can spend here over the 61.8. Comment how many times I just said time, and you will win, I don't know, something. What else is going on? Let's take a look at the volume profile and see what we can see. Resolving this in the upward direction, no doubt about that, but running into an overhead high volume node. This high volume node coincides with structure as well. So is it reasonable that the QQQ could pull back and see a higher low? Absolutely. There's no reason to even believe that in 1 week's worth of trade, we could jeopardize the new uptrend that's built out here. If we take out the Fibonacci's from the low, just like we did in the S&P from back here in March, up to the high, the 38.2 is not even within striking distance, right? It would really require an Armageddon type situation to get there in the coming weeks worth of trade. We'll bring it up when and if it becomes relevant, but right now, not really a concern for the QQQ. Let's take a look at the daily time frame chart and see what else we can learn about expected move patterns and all that good stuff here. Zooming in, the expected move is very similar to the SPY with the suggestion of a very nuanced higher high. The level is technically 343.75 and a higher low. For the sake of just simplicity, let's call this an equal high, but certainly a higher low. That level is 360.75, somewhere in that general range. If we pull back to it, remember that that's the exact equal touch from the FOMC and the Tuesday low gap fill reversal. That's going to be an incredibly weak area of support. If we find ourselves trading around that range, there's a very clear short setup. Let's go down to the daily time frame chart, or excuse me, hourly time frame chart here and see this, right? There's a very clear short underneath 360.75 to break the week low, because this is so precise off of a gap fill reversal. Remember that the breakout on Monday afternoon session, it's thin structure. There's not a whole lot there to really support markets. That, in theory, could be an easy short, an easy breakdown into 357.25. And when I say easy, it's easy to identify. Remember that execution is always the hard part when it comes to trading markets. What else can we learn on the hourly time frame chart here? Certainly still looking for higher lows, just like the S&Ps. We broke down underneath this into the end of Friday's session. So bears want to see consolidation or lower highs underneath 369.65. Target would be the Wednesday high. And then when and if we get here, certainly reevaluate, right? If we take out the Fibonacci's and do something that looks like this, coming from the Monday low, that's when the market broke out of the daily flag range, right? When and if we get here, 38.2 is sitting there to meet you at 365.75. 365.75 is your 38.2. And we can also take out our anchored VWAP and do the same exact thing that we've been doing here. We've got to bump this forward though. Remember that we've got to go 1, 2, 3 days for the 12th. There we go. Anchored VWAP, confluence of support, 365.75. Certainly looking for the most optimal setup would be a hammer candle, some sort of double bottom, intraday inverted head and shoulders to find a higher low and continue the hourly uptrend that we have going on over here. Let's go ahead and take a look at the internals for the NASDAQ side of things. We do have mild outflows on Friday, just like the the S&P not breaching the negative 400 million mark in the downward direction. Net flows are positive on the week at the significant read mark, 600 million in the NQ side of things. If we look at the advanced decline line, once again, credit where credit is due, slashing the zero line, but not really getting down towards trend lower zone in here. Cumulative tick is very mild on the Friday session. Once again, seems like a reasonable pullback to me, not so much an outright collapse that is really threatening a major breakdown or reversal of the trends that we have going on currently. Let's take a look at the market profile out of the NQ. What do we see here? Same exact idea, repairing the poor high. Value area point of control is centralized in Friday's range. We've got a mechanical level. You might want to watch that at 15,420. If we break that, again, opening inside of Friday's range, breaking 15,420 in the NQ futures, look for the rotation to Friday's high. That is a scalp in the upward direction. If we break to the downside, taking out the low of Friday, that's technically your mechanical level because we do have the value area low from Thursday there. It's not so clean cut like it is in the ES for your downside pullback based on the market profile. So if you are looking for that short, to me, the ES seems more structurally sound. We have cleaner levels to pay attention to. But for the most part, right, out of the NQ, the main takeaway here for me at least is just that the value area is centralized. The point of control is centralized. There's no deficiencies in the structure now that we've repaired this poor high and this poor high from in the past as well. IWM weekly time frame chart. What do we see here from a candle structure perspective, location perspective? Certainly one of these things is not like the other. Shooting star out of the IWM, large upper wick, certainly implies that the sellers stepped up here and were able to close prices back down towards the lower third of the weekly range, but we do technically have a green bodied bar, so they were unable to push prices back down underneath the opening print. Very nuanced take, though, is that the close was back down within the prior week's range. We do still technically have on the location standpoint, though, a higher low as well as a higher high bar to bar, and clearly there is an opportunity for a weekly higher low to be produced above the prior weekly range from in here. If you want to draw in the larger weekly range, nothing too impressive has happened yet. Don't get me wrong, on the day-to-day basis, this certainly is improving, but in the grand scheme of things, not a lot has really happened out of small caps. Doesn't really make sense to put Fibonacci's on this so far. Let's drop it on down to, I guess we could go to the volume profile and then we'll go down to the daily. What do we see here? We know that we've got a strong volume base underneath us. We are kind of rotating towards this high volume node. So once again, inverted hammer, rejecting the break from the prior week's range. It would be reasonable that the IWM could experience a pullback here to backtest the break and retest basically of the range that it broke from this perspective, right? This is totally reasonable. That would be the most optimistic look for the IWM on the weekly time frame chart at this point in time. We can also throw on the anchored view apps in the IWM because they're still very much so in play here. Notice that your all-time high anchored view app acted as resistance with the high volume node that we were just looking at, and your October low anchored view app may actually provide confluence of support at the top of the prior weekly range. So your anchored view apps here very much so still in play in the IWM. Let's take a look at our daily time frame chart and kind of get an understanding for what's going on from this perspective. If we zoom in, expected move is really neutral here. It is suggesting a nuanced higher high at 189.60 or a lower low. That's the concern really out of IWM, is breaking down from this bull flag consolidation range. The lower low ushers in a move through the thin structure and likely leads to a deeper breakdown. 182.31 is the suggestion, but I would start to really consider this, the top of the weekly range at 179, as being much, much more important. What else can we see here? 184.75 is the bottom of the bull flag, and if we take out the Fibonacci's from the low of the gap up candle that kicked off the move to the top, it's also your 38.2, right? So that's just building the case, confluence of support at 184.75. You really want to see that hold. If it breaks, things certainly start to get a little bit more nasty. Let's take a look on the hourly time frame chart. You could make the argument for two things. Number one would be the bull flag that we just saw on the daily time frame. This is your consolidation up here. Number two would be that this is actually turning into an inverted, or not inverted, but regular head and shoulders for something that does this, right? And once again, where's your key support point? It's still that 184.75. So nothing really changes about that level. Just depends on how you want to look at the structure here. One reason I would probably opt to be slightly more cautious and not look at it through the lens of, rose glasses and bulls on parade is because Friday gaps up over the top of the prior range that was established, right inside of the value area here. from the Tuesday session, and it completely fails to hold the value area low from that session, the level at 187.50. No hold there, no hold here from the breakout point on Thursday, and we close week back down inside of the original consolidation range, kind of centered in that range. So 184.75 is really the biggest threat in the downward direction. We know that we do have thin structure off to the left that could be retraced fairly quickly. If we throw on an anchored VWAP just to be consistent, we've obviously got to back this one off to the breakout day. That is going to be 0602. There we are, and apply that. That's anchored to the gap up day that kicked off the move. Confluence of support, right? So 184.75, can't talk strongly enough about that level. That is your gatekeeper out of the IWM. If we take a look at the Russell futures, apologies for not having this loaded up ahead of time, the net flows on the week were exactly flat. It's not so much that we had big bearish outflows on Friday, but net on the week, certainly not nearly as impressive as what we saw out of the NQ and even the ES markets. If we look at the advanced decline line, once again going wall to wall, getting closer to, though, negative trend territory down below. Cumulative build, not all that bad on Friday. Once again, in the IWM, I really do think that it boils down to what goes on with 184.75. I thought to myself, oh, I'll just skip out on the Russell futures in the market profile. Nobody really cares about the Russell, but this nuance is too glaring to not include in the video. Value area and the point of control from Friday on the Russell are clearly different from what we saw out of the ES and the NQ, shifted lower with price on that Friday session. This is much more of a bearish indication. We've also got a very classic B-shaped profile, that's lowercase b, of course, here, which indicates long liquidation at the top. So nobody really wants to be long the Russell at the top of the bull flag range right now, and that's something to consider. If we break down underneath that 184.75, I wouldn't be surprised based on some of these indications. And we know that the threat as well is the massive string of single prints from back down over here. We just talked about that on the structural chart, right? We know that this is the threat. So 184.75 needed to include the profile. If you've made it to this point in the video, I just want to take this time to say a massive thank you. Appreciate you tuning in, and I truly hope you have a great and relaxing long weekend. Apple's going to kick off the core list of companies. What do we see here? Gapping up to a new all-time high on the Friday session, but really, it's still in a very strong uptrend. If we can turn around instantly on the Tuesday open and hold 184.50, it's bulls on parade, clear higher low on the daily time frame chart. If we drop it on down to the hourly to look at the structure a bit more, you might want to consider this an hourly head and shoulders, and thus price acceptance with an hourly lower high underneath 184.50 could be tradable for a deeper pullback towards 182. That would be the primary watch early on in this week's worth of trade. Let's take a look at Netflix, certainly producing more of, again, we're still on the hourly time frame chart, a double top up here and violating the neckline into the close of Friday. Bears want to see lower highs underneath 436.50 to close the gap underneath us here, and then it's fair play to just look for consolidation inside of the prior two-day range over in this area. If we get a higher low back above, not really convinced that I want to be aggressive long there. It would really require a break of the equal highs around 448.25 to get going in the upward direction. This is going to be a weak level considering how many times it's been tested without a break yet. Let's take a look at Tesla, what's going on over here. Still putting in beautiful bullish patterns. I mean, gap up over the Thursday consolidation range and then went sideways on the day, building out price acceptance higher. We have an exact top here at 262.50. If that breaks, there's lots of room to run overhead. Not calling for this immediately because yes, on the daily time frame chart, Tesla remains fairly extended at this point in time. You want to be very cautious of buying new higher highs, right? So be cautious of that, but technically the bulls are in control, right? A very mild pullback resulting in a gap down here was bought right back up. If this turns into an equal high break, there's nothing saying not to go with it as long as you can pick off a risk-friendly entry up here at these highs. Maybe it's a break, retest, and higher low above. That gets interesting from a risk-reward perspective. Bears really only have something going on if we can break down under 250.75. Let's take a look at Google. This is still the hourly time frame chart. The gap up, this strikes me as more like the IWM, even though Google is obviously not a small cap. It gaps up over some consolidation range, right? Does not hold here and does not hold here into the close underneath 123.75. So my hunch is that if Google wants to truly produce a fake break in the upward direction here, it's going to require price acceptance underneath 123.75, and then that level I discussed on Thursday is right back on the table at 122. If we want to turn instantly and produce a higher low and then get back above 125, I would only trade it if we get a higher low over 125. Note the inverted hammer lower high happening here. That's the threat. So not really interested in this area. Lower highs highs underneath, target the 122 big flush point. That gets interesting on downside. Then longs, be patient for the better higher low over 125. Next up, Metaverse and the Fantasyland. What's going on over here? Most of the gap has been closed now, so I wouldn't really be looking for risk reward entries to close that gap any longer. It's not really the spirit of the trade, so to speak, right now. And instead, I would be looking for higher low pullbacks anywhere over 275. Flipping back to a daily time frame chart, this level is as clear as day. Inverted hammer on the daily bar. If we get a break of Friday's low, looking for the rotation 275, seeing if we can find a hammer candle down here. Intraday on the hourly chart, double bottom, inverted head and shoulders. You know all the patterns that go there. 275 is the primary area of interest. Technically could find a higher low at 269.75 from this perspective, but you would be pushing it. Obviously, the risk there is that you then get a lower high under 275, and that becomes an issue. Let's take a look at NVIDIA. Pullback, all-time highs. I mean, everything about this chart, very difficult to step in front of the freight train. I wouldn't recommend it. Let's take a look at the hourly time frame. You've got a nuanced flush point happening here, right? Prior high acted as support. This gap up didn't really hold on the Friday session, so underneath 421 might get interesting for this rotation into 411.25. Take this one day by day. Very difficult to say anything about aggressive downside trades in NVIDIA when we're gapping to new all-time highs. This obviously very, very impressive. Continues to get upgrades, continues to be in the headlines based on everyone talking about AI and all the stuff that's going on there. Microsoft, strong rejection off of the all-time high. This is perhaps the deepest pullback that we saw on the Friday range, but notice it's still above this area. So I would be watching for the continued pullback into 338, test it, and see if we want to produce a higher low there. Here's the hourly time frame, and you can see there's kind of your pseudo head and shoulders, right? Any lower highs that continue underneath 345.50, 338 should be the target, and then we'll look for that higher low reversal. Anything underneath that, just like what we discussed in NVIDIA, or maybe it was Meta, I can't remember now. It was definitely Meta. The threat becomes a lower high underneath if we move underneath 338, so carry that forward. Amazon still on an hourly time frame chart, building out a very, very clean ascending triangle. All eyes on 127. Mild day on Friday, certainly nothing impressive or aggressive, I should say, on the downside. So if we can consolidate over 125.50, watching for that upside break, the overhead target is 131.30. If we break the trend line, just walk down your supports, right? Next level, 123.25, then 121.25, and then the base, this is your most important support at 118.50. A couple of trade ideas and then you are on your way. Uber is up first, and you'll notice that we have a 3-bar play setting up here with a hammer candle inside bar on the Friday session. Whereas almost everything else on the watch list was red, Uber puts in a green hammer after testing lower earlier on in the session. So it closes up at the highs. If we can take out the 2-bar highs at 43.56, the next overhead target is up towards 45.83. And that's coming from quite a ways ago, right? Quite a while ago, way back here. We haven't seen those levels since late 2021. So keep that in mind as an upside trade if the markets are moving in the upward direction. If markets are moving in the downward direction, AMD is on the chopping block, right? Obviously, it's being massively overshadowed by what's going on in NVIDIA right now from a fundamental perspective, but technically, right, we gap up to a new high on the, what would that have been, Tuesday session, and it absolutely does not hold. Solid bearish engulfing bar. Even after that, we try to pull back and find a higher low, hammer out that higher low on the Wednesday and Thursday session. No love there with a Friday close underneath. So looking for shorts based on technical weakness and fundamental overshadowing by NVIDIA, and the trade is to essentially look for this gap close. It's underneath 116.50, closes down towards 111. It's not in play yet. We're not sitting on that level yet, but that's the general spirit of this trade out of AMD if the markets are weak this week. Let's take a look at GIS to wrap things up here. I was about to say this is Goldman Sachs, but it is absolutely not. It is General Mills. Very, very different sector. The chart looks incredibly weak, right? Multiple inverted hammers, a whole lack of conviction in the upward direction here, rejecting the 200 SMA, the green moving average on your screen. Earnings are around the corner on this one, not this week, but the week following. I would just watch out for a flush underneath 80.48. The options chain is not fantastic on General Mills, but it is easy to borrow, at least here in Thinkorswim, so you can just short the shares, and the target would be down here towards this prior set of support around 78.50. That's going to do it for today's episode of the Weekly Watchlist. If you enjoyed the video or learned anything new, let me know down below in the comment section or by leaving the video a thumbs up. I truly hope all of you have a great and relaxing long weekend, and I will see you at 8:15 sharp Tuesday morning to resume with the pre-market prep. With that said, have a green trading week.